This is the Deep Dive. We are back, and we are dialing up the intensity today. If you're listening to this, there's a very good chance you are deep in the trenches of exam prep. Maybe you're staring down the barrel of the CEP exam, or maybe it's a brutal finance final.
Right.
Whatever it is, we're treating this session like a closed-door study group.
No fluff today. We're looking at Accounting for Equity Compensation, the 20th edition by Barbara Boxa.
And we are not skimming. We are surgically targeting the two chapters that usually cause the most panic. Chapter 9, Business Combinations, What Happens When Companies Merge, and then Chapter 10, Earnings Per Share.
The heavy hitters. Chapter 10 is especially critical. I mean, you really can't understand public company reporting without mastering EPS.
It's everything.
It drives stock prices, executive bonuses, everything.
So the mission is simple. Demystify the mechanics. We want to move you from just memorizing rules to understanding the logic. Because if you understand the why, you can reason your way through those tricky exam questions where the answer isn't, immediately obvious.
The logic sticks, memorization fades. So let's start with the chaos of a merger. Chapter 9.
Right. Let's set the scene. Company A buys Company B. Company B has a bunch of employees holding stock options. Some are vested, some are not. The deal closes. What happens to all that paper?
Well, typically, those awards get exchanged for awards in the new acquiring company. But for the accountant, this exchange creates a massive headache. You have to figure out who pays for what. And the first thing to remember, and this catches people off guard, is that ASC 718, your usual stock comp rulebook, it kind of takes a backseat here.
This is ASC 805 territory.
Correct. Business combinations. And ASC 805 demands we split the reality of that award into two different buckets based on the consummation date. So the day the deal actually closes.
We're allocating value. So bucket 1 is the value tied to work the employee has already done.
Exactly, the past service bucket. And here's the crucial exam takeaway. The value in this bucket is treated as part of the purchase price of the acquisition.
Okay, that's a vital distinction for the P&L. If it's purchase price, it isn't hitting the income statement as an immediate expense, right? It's just part of the capital cost of the deal.
Precisely. It gets capitalized. But bucket 2, future service, is different. This represents the portion of the fair value that's for work the employee has yet to do for the new company. Since that benefit goes to the new entity has to book it as compensation expense over the remaining vesting period.
So let's look at the math then. If I'm 3 years into a 4-year vesting schedule, presumably 75% of my awards value goes to purchase price and 25% becomes future expense.
In a standard time-based model, yes, it's a straight ratio of days worked versus the total vesting period.
But here's where the real world clashes with the exam world. That math relies on having a fair value for the options. And in the middle of a merger, with stock prices going wild, how do you actually pin down that number to do the split?
It's incredibly messy. The text specifically highlights the expected term assumption. How long will people hold these new options?
Right.
Historical data is useless because, well, the company just got bought. The culture's different. The stock is different. You just can't rely on what employees did 5 years ago.
So you can't just look at the old company's behavior.
No. The text points to a few safe harbors. One is the computed expected life method from the IRS. That's Revenue Procedure 9834.
That sounds like a deep cut.
Very deep, but it's a weighted average approach that is acceptable. Or you might try the simplified method from SA 107.
Wait, I thought the text specifically warned against using the simplified method in mergers.
It does, and that's a nuance you have to catch. The simplified method is meant for plain vanilla, at the money options. In a merger, the replacement options are almost never at the money.
Because of the exchange ratios.
Exactly, so they lose that plain vanilla status. Relying on the simplified method is risky. You're often stuck using peer group data or maybe running a Monte Carlo simulation.
Before we leave Chapter 9, we have to touch on the double check, this idea that you have to compare value before and after the deal.
This is, let's call it the anti-corruption rule. You have to ensure the acquiring company isn't using the merger to sneak a raise to employees.
I see.
You have to compare the fair value of the awards immediately before the deal to the value after.
And if the value goes up?
That's called incremental cost. And you absolutely cannot hide that in the purchase price. If the new award is worth more than the old one, that excess value is treated as compensation expense.
Okay.
Immediately if vested or over time if unvested. Basically, you have to pay for the sweetener.
Got it. Past service is purchase price. Future service is expense. And no sneaking in extra value. Let's pivot to the beast. Chapter 10, Earnings per Share.
This is where I see the most confusion, but honestly, the logic is really elegant once you see the mechanism.
Yeah. It starts with the two tiers, basic EPS and diluted EPS. Yeah. I like to think of basic EPS as a very exclusive club. Who actually gets in?
Only the shares that are truly legally outstanding, issued and vested. That's it.
So, stock options.
Out.
Unvested restricted stock awards.
Out. And that's a trap for so many people. RSAs have voting rights, you get dividends, they feel like real stock.
Right.
But for basic EPS, they're considered contingently returnable. Until they vest, they are kicked out of the basic club.
So basic is strict. Then we have diluted EPS. This is what I call the doomsday scenario.
It's the what-if scenario, exactly. What if everyone who could get stock did get stock? We have to account for all those options, SARs and unvested RSAs. And to do that without just, destroying the stock price, we use the Treasury stock method.
The TSM.
Yeah.
I want to spend a minute here because this is the engine of Chapter 10. It's a three-step dance: waiting, exercise, and the phantom buyback.
Let's start with step 1. Waiting. You only count the options for the time they existed during the period. Simple enough. If I grant an option on June 1st, it's only in the denominator for 1 month of the quarter.
But here's the snag. What if an option is canceled? Say an employee quits on May 31st and forfeits their options.
They're gone. So you ignore them.
No. That option was alive and potentially dilutive for 2 months of the quarter. It haunts the calculation. You have to weight it for the days it existed, even if it's dead by the time you print the report.
Ghosts count. That is a critical detail. Okay, moving to step 2 and 3, the phantom buyback. This is where we calculate proceeds. We pretend the employees exercised their options, gave the company cash,
Right.
and the company used that cash to buy back its own stock to offset the dilution.
Exactly. If I issue you 1,000 shares but buy back 1,000 shares with your cash, the net dilution is 0.
But the proceeds bucket isn't just the cash from the exercise price. The text lists another massive component: average unamortized expense. This is the part that trips people up. Why does future expense count as cash to buy back stock? Think of it as labor currency. The accounting view is that the employee is paying for their stock with their labor. That future labor creates value revenue for the company.
Okay.
The Treasury stock method assumes the company theoretically receives that value and then uses it to buy back stock.
Okay, let me trace that logic to make sure I have it. If I have a brand new grant, that means I have a lot of future service left to provide.
Which means the company has a large amount of unamortized expense on its books.
So under TSM, that big pile of expense acts like a big pile of cash.
Exactly. You have a giant pile of phantom cash, which means you can buy back more shares.
Which means the denominator shrinks. So counterintuitively, a newly granted option is actually less dilutive than an old, nearly vested option.
Precisely. As the option vests, the unamortized expense, your phantom cash, it dries up. You have less buying power, so the dilution actually increases as the award matures.
That is a huge insight for the exam. High expense equals low dilution. It feels backward until you visualize the labor paying for the buyback.
Yeah.
Now let's look at when the math breaks. What happens with anti-dilutive awards?
This is where we apply the rule of conservatism. In accounting, you are never allowed to accidentally make your earnings look better than they are.
So if my calculation shows that an option would increase EPS,
you pretend it doesn't exist. This usually happens with underwater options, where the exercise price is higher than the market price.
Oh, right.
If you ran the math assuming exercise, you'd be collecting, say, $50 cash per share when the market price is only $30. You could buy back more shares than you issued.
Which would shrink the share count and boost EPS.
Which is illegal in this context. If it helps you, ignore it. If it hurts you, report it.
Brutal. Let's close Chapter 10 with the trickiest instruments. Performance-based awards. The ones tied to revenue targets or IPOs. When do they enter the diluted EPS calculation?
The rule is strict. You only include them if the award would be earned based on the performance as of the end of the reporting period.
So no forecast.
Zero forecasting. Even if the CEO is on TV guaranteeing they'll hit the target by December, if they haven't hit it today, those shares are excluded.
But what if the target is cumulative? Say the goal is $10 million in revenue for the year. By Q3, we're already at $11 million. The year isn't over. And technically, we could have returns or losses in Q4 that drop us back down.
Doesn't matter. You look at the snapshot today. Have you met the condition right now? Yes. So you include them.
What about market conditions? Like total shareholder return, TSR?
Those are volatile. If the stock price is high enough to trigger the vest today, the shares are in. If the market crashes tomorrow, they're out next quarter. It causes the diluted share count to bounce around, but that just reflects the reality of the obligation.
And before we get to the review, I want to circle back to basic EPS one more time just to lock it in. We said RSAs are out, performance awards are out.
Correct. For basic EPS, section 10.6 specifically, nothing gets in until all conditions are met and the shares are fully vested. Even if you've satisfied the performance condition, if the time-based vesting isn't done, it is not in basic.
All right. We've covered the merger timeline split, the ghosts of canceled options, and the phantom cash of the Treasury stock method. I think we're ready to test this.
Let's run the rapid fire.
Okay. I'm going to throw out 3 scenarios based on what we just discussed.
Yeah.
I want you, the listener, to try and answer before our expert does. Don't wait for the answer. Commit to one in your head. Question 1. Back to Chapter 9, Business Combinations. We are splitting the fair value of replacement awards. Where do we record the value attributable to service that was already provided before the acquisition?
That goes to the purchase price. It's capitalized as part of the cost of the deal, not expensed on the income statement.
Question 2. Treasury stock method in Chapter 10. Besides cash from the exercise price, what is the other major proceed we assume the company uses to buy back stock?
The average unamortized compensation expense for the reporting period. Remember, future labor equals phantom cash.
And question 3. Performance awards. We expect to hit a revenue target by year-end, but we have not hit it yet. Are the shares included in diluted EPS?
No. You assess status as of the end of the reporting period. No forecasting allowed.
How'd you do?
If you got those 3, you are in a very strong position for the exam. You understand the allocation in mergers and the conservative mechanics of dilution.
Just to wrap this up, if our listener is sitting in that exam room and hits a mental block, what are the anchors? What should they remember?
For Chapter 9, think allocation. You're splitting the bill between the past, which is purchase price, and the future, which is expense. For Chapter 10, think worst-case scenario. We assume dilution happens, but we use the Treasury stock method to soften the blow logically.
And remember that phantom buyback, labor buying stock.
It's a weird image, but it makes the math work.
Absolutely. It connects the accounting to the economic reality. Huge thanks for sticking with us through the dense stuff. This deep dive was based on Accounting for Equity Compensation 20th edition. Good luck with the prep.
You've got this. Go crush it.